Should you be investing in blue chip property or blue collar?
Cash flow per annum, we are negative.
A lot of people think blue collar investments are just going to get trashed.
This is how some lucky public housing tenants live.
No way! Get your camera off me, mate.
Whereas blue chip real estate feels so much more safe and secure. But what does the data say?
So in 10 years' time, approximate value would be a 2.6 million.
Together with property investor and founder of Suburbs Finder, Gilbert Melgar, we unpack this debate in detail.
It's going to be really an interesting debate. There's money to be made on both. But
To answer the question, what's better, blue chip or blue collar property investing?
there's no right or wrong. But, for me, I'd go for
This is a fun episode to make, pulling apart the data on two very different kinds of asset classes, giving you a clearer picture on the pros and cons of both asset types. My name's Todd Sloan. This is the Pizza and Property Podcast, and this episode is sponsored by the Property Developer Network, InvestorKit, Suburbs Finder, and Inside 2. More about our amazing show sponsors in the show notes below. Right now, let's jump straight into the episode with Gilbert Melgar. Gilbert Melgar, you ready for another Versus episode, man?
yeah, definitely.
Mate, I'm liking this one because this is one that's a hot topic and has been 20, 30 years, okay? It's been around for a while, and I feel like there's a lot in this episode that can potentially put it to bed, which is a big claim, but I think there's a lot of what you've put together here that makes a lot of sense. Blue chip versus blue collar. Mate, is there anything you wanted to set the stage with before we start unpacking a lot of the data behind this?
It's going to be really an interesting debate.
Absolutely. Now, we're going to be talking about this, and Gilbert's really prepared everything through the lens of building a property portfolio, and more so for the average Aussie. Because, let's face it, if you're earning $1 million a year, you've got a lot of different options on how you're going to build a portfolio. For an average Aussie investor, your options are a bit less than if you're
Limited.
on a lot of money. So why don't we actually start with price point?
Well, price point is for blue chip, it's say 1.5 million and above.
Yeah, that sounds about right, depending on where you are. It's a lot, yeah.
Exactly. Well, the constraints there is not every investor has a borrowing capacity of 1.5. If it's going to be your first investment, it's going to be a really high entry point as an investment, especially if it's your first.
Well, especially if you're talking 1.5, I feel like that's probably even the lower end of blue chip for a lot of areas now. So then that's potentially like 2 investment properties elsewhere, 3 in some cases, depending on what you're actually looking at, but otherwise quite comfortably 2. So what you're basically saying is like the price point itself is like just the first hurdle.
Yep.
All right, and then for blue collar, we're literally talking the opposite, but it's not just the opposite as in like it's a little bit under 1.5. We're talking for anyone that's newer into property investing and sort of really getting the ropes of this. What kind of price points are you usually talking?
So we're talking about between 400 to 800, which is for an average Aussie like me. It's pretty affordable as an entry level for first-time investment.
Now, the big thing that gets me though, and has always got me about this debate, is the rental yield. Typical rental yields for blue collar versus blue chip. What are we talking about through that lens of portfolio growth as well, like how this actually affects your growth?
So rental yield, blue chip, between 2.5 to 3.5%. So compare that to blue collar, which is between 4 to 6% or sometimes even above 6%. If you're paying for, as we say, 1.5 is already on the low side, so let's say at 2 million, right? Having a yield of between 2.5 to 3.5, that means you are so negative in terms of cash flow. So for you to hold that property, you'll be shelling a lot of money to hold it.
Now, you've actually got some numbers prepped. Let's take a look at it, because it's one thing to say 3%, 5%. Like, let's put this in dollars. What does it actually look like as far as cash flow?
So in terms of cash flow, so let's say our budget is 1.5 million, right? If we're buying on a blue chip, so that's one property, compared to splitting that to
2 sort of blue collar properties?
Yep, exactly.
Yep.
So let's say 750 each, right?
Yep.
So same, all areas will have a growth rate or compounded annual historical growth rate of 6%. Right? 20% deposit and all.
Everything else is the same?
Everything else is the same,
Yep.
except for the yield, right? Because we mentioned a while ago, blue collars rental yield is between
Anywhere from like sort of
4
4
to
to
6,
6. Yeah.
right? Sometimes it's above.
Yep.
So we're put in the middle at 5% rental yield.
Okay.
And then for blue chip, it's between 2.5 to 3.5. So we're putting in at 3% rental yield.
Okay. And what are we looking at numbers wise?
So numbers wise, cash flow per annum. For blue chip, we are 41,000 negative.
What
for
interest rate
cash
is
flow.
that?
The interest rate is at 6.4%.
Depending on when you guys are watching this, it could be higher, could be lower, but like 6 is around that historical average, yeah?
Yep.
Yeah.
Hopefully it's lower
Okay. Yeah.
by that time.
And so negative 40 grand a year,
Negative 41. Yep.
negative 41. And the blue collars?
And the blue collar is negative 10 grand for each.
Okay, so negative 20. So negative
20.
half.
Yeah. But
Yeah.
when we're looking at, mentioned a while ago, compounded annual growth rate,
Yeah. Is this where blue chip's
Same.
punching ahead or?
it's the same for, I said 6%. Let's say 6% for both blue collar and
This is always the argument,
Blue
though.
chip, right?
Is it's like, no, you're going to lose on the negative cash flow, but it's okay because your property is going to perform better because historically blue collar areas don't perform as well as blue chip areas. But so now you're saying, no, that's not right. You've got data that's saying they're performing pretty much the same over not just the past like couple of years. You're talking about like 10 years plus, that kind of thing?
Yep. For example, right? So I'm just going to refer to Ascot in Queensland, which is a blue chip, and in Mossman, New South Wales, right? Compounded annual growth rate is within the 6%, 10-year.
So for anyone that's not familiar with those areas, which one's blue chip, which one's blue collar?
No. Mossman in New South Wales and Ascot in Queensland are both blue chip.
They're both blue chip.
Yeah.
Gotcha. Okay.
So compare that to blue collar, which is Logan, Queensland, and St. Mary's in New South Wales. Logan had a 8% compounded annual growth rate.
So
while
higher.
St. Mary's
Yeah.
is within the 6.4.
Okay.
So we're looking at long term,
pretty much
pretty much the same, right?
if not higher in one category.
Exactly. So if we're going to look at it in 10 years' time, provided that the growth continue, either blue collar or white collar or blue chip. So in 10 years' time, that blue chip will be approximate value would be at 2.6 million.
And basically, I'm assuming you're about to say that the two blue collars put together are roughly the same again.
Yep. So one would be 1.3 mil and the other one is 1.3 mil. So if you add both, same 2.6 mil.
To anyone that watches the show, it's no secret that I'm not a blue chip investor. Our whole portfolio is very much blue collar. And the yield is one of the big reasons. I've always genuinely thought, though, that there is maybe a little bit of growth that could have been missed out on, and that it could maybe go, okay, maybe I could have done a little bit better elsewhere. But I've justified it away going, but I couldn't have built the portfolio as big because the yield is so necessary to actually do that, the cash flow. Otherwise, you're tapping out after one or two. What's the downside here? Because right now, you're looking slam dunk for blue collar.
Well, I wouldn't say a downside, but one thing that we as an investor should be mindful of, there's a bit of volatility in terms of price fluctuation for blue collar areas.
It's a bit more vulnerable.
Prices change more often compared to blue chips. For example, Logan and St. Mary's. So as you can see here, there's a lot of times that prices has gone up, gone down, and gone up again. And now it's continuously going up.
Okay.
So
all right.
compare that with Ascot and Mossman. Mossman has a bit of an upswing, but there's a pretty consistent increase in pricing, not as drastic as the two examples that we've shown, blue chip. And compared to Ascot, the increase happened during the start of COVID, but after that, it remained pretty flat.
All right. So basically, the downside that I'm hearing so far for blue collar, you might get a better yield. You might get reasonably much the same kind of capital growth longer term. But in that short term, you might see maybe a little bit of a fluctuation, a dip in your equity. And that's something that you've got to be prepared for.
Yeah, especially if you're going to sell.
Yep.
If your objective is not holding it for the long term.
All right, talk to me about tenant damage. Now, it's something that I hear of quite a lot when I'm talking to someone blue chip, blue collar, and it's kind of like, well, I don't know about that area. It looks a little bit like rougher around the edges. I'm probably just going to get a tenant that trashes the place. And while sometimes that can be true, it's not always true. However, it's a genuine concern. So what kind of data do we have on that?
I wish I have the data on that. That would be awesome, right? But
Is it not something that's measured?
not something measured, because the best way to approach this is by calling the different local property managers in the area, because they have better data when it comes to this, because not only that they have it on their file, but they're the ones who knows the demographics of the people living in that area.
And the good thing about actually talking with a PM, I like this point, is that a sales agent, once you've sold the property, you're done. You're on to the next one.
Exactly.
Like, whereas a property manager, they've got a long-term relationship. They don't want you to pick a tenant that is maybe going to be a nightmare, because they've got to then manage that, deal with that constantly, potentially for years. So it's actually in their best interest to go, this is the truth. This is how it is, and just not even sugarcoat it. And I don't know, has that been your experience with property managers as well? They're very like matter of fact.
Yep. That's totally true. Sometimes they even provide better insights of the area. Let's say if you want to buy in an area, sometimes they're the best persons that you can talk to if you're buying. Because at the end of the day, if they're the one managing it, as you say, they don't want any headaches in the future.
In summary then, blue chip versus blue collar. This has been a little bit of a different one for our versus episodes because we're kind of getting to the crux of this a bit quicker. I feel like it's definitely leaning in one direction, but which way would you really make this swing for you, given what the data says, as far as rental yields, as far as capital growth, as far as price point, risk profile, all the rest of it?
Well, there's money to be made on both. Right? If I have the opportunity or I have the money to go to blue chip, and if I have the capability to hold the property, like let's say if I know I'm going to earn 20 million and I have 4 million in cash to hold it for 10 years, why not? But not everyone has that.
They don't?
Why are we here? But yeah, so I'd say there's no right or wrong, but you know, for me, I'd go for blue collar because that's the opportunity I have. That's the opportunity I can control.
So it basically sounds like if you're willing to pay the extra, blue chip might have a few less hassles. There might be a few things that are slightly easier about it. Your growth, though, realistically, is going to come out in the wash the similar way, but that comes at a cost.
Yes, exactly.
Got it. To me, the biggest takeaway for this is if you're portfolio growth focused, you're not focused on, I just want to buy a property, that's totally different. But if you've got that focus on growth, the biggest thing that I want you to take from this is around that property yield, that cash flow. Talk to your broker, because what Gilbert's just shown us here, negative $40,000 versus negative $20,000, obviously that's one example in isolation. But if you were to sit down with your broker, Gilbert, like with your personal situation, and show them double the amount of negative cash flow as one option versus the other, it's very quick. They're going to be telling you, okay, if everything else comes out pretty equal in the wash, I can tell you which one's going to help you move forward quicker than the other one. And I think that's the big takeaway that I really want people to get from this personally. Talk to your broker. Talk to them about what's the next step from here.
Yeah, totally agree with you, Todd. So the best person to talk to are your mortgage brokers, because they know your financials and everything and what steps you need to take in order to move forward.
100%, man. As always, it's been an absolute pleasure. Gilbert Melgar from Suburbs Finder, thank you so much again for coming on the show, man.
Thank you. Thank you for having me again.